Have you ever looked at a rental deal and thought, man, this would crush it as an Airbnb, but then the lender runs the numbers on the current rent and basically says, nope, deal's dead. That gap right there between what a long-term tenant pays and what a short-term rental can actually bring in is where a lot of investors either unlock huge opportunity or get themselves into trouble. And I want to show you exactly how that works because it's not magic, it's math. So here's the deal. Traditional lenders look at what's happening right now. They look at existing leases, current rent, maybe a market rent estimate for a standard 1-year lease, and they plug that into their formula. If the rent doesn't cover the projected mortgage payment well enough, you're done. It doesn't matter how many TikToks you've seen about Airbnb riches, the loan just doesn't pass their test. But with DSCR lenders, especially those that are open to short-term rentals, the way they look at the income can be completely different. And if you understand that, you can turn dead deals into live ones. And you can also avoid walking straight into a money pit. So let's walk through how this really works. When you're dealing with a standard rental loan that leans on long-term leases, the lender is basically asking one question. Does the property pay for itself on paper? They're looking at a coverage ratio, which is just a fancy way of saying how much rent comes in compared to the total payment going out. If that ratio is under their minimum, they don't like it. Imagine an appraiser comes in and says, this property would rent long-term for a certain amount per month. Then your projected mortgage payment with taxes and insurance is higher than that rent. On their worksheet, that coverage ratio falls under 1. And as far as they're concerned, the property can't carry its own weight. Now here's where the so-called hack comes in. Some DSCR lenders will allow you to qualify not based on a traditional 1-year lease number, but based on short-term rental projections. Instead of asking what a 12-month tenant would pay, they ask, what could this thing do on a platform like Airbnb or VRBO if it performs like similar properties nearby? To answer that, they might use a data provider like AirDNA, or they'll order a specific rental analysis from the appraiser, sometimes on a form that's designed just to estimate market rent for an investment property. That report might show projected gross income from short-term stays that is way higher than a boring long-term lease. So picture this. In the long-term world, the appraiser says your place will rent for a certain amount each month, but your mortgage payment is significantly higher. On paper, the lender sees more going out than coming in and the deal is dead in the water. But when you look at it as a short-term rental, good data might say based on occupancy and nightly rates in this area, this property could gross a much higher amount per month. Now, lenders don't just take that full gross number and pretend there are no expenses. A lot of them will apply a haircut. Something like, we'll count only a portion of that gross to account for vacancy and costs. That discounted number is what they plug into their DSCR formula. Suddenly the ratio on their screen flips from not enough income to comfortably covers the payment with room to spare. Same property, same street, same purchase price, totally different answer depending on which income story you tell. That's why some investors absolutely love this strategy. They're buying distressed or vacant homes that would never pencil out on a basic rent schedule, turning them into short-term rentals. And the only reason the deal even gets funded is because the lender allowed STR-based projections. Now, this is where we have to talk about the danger, because this is also where people blow themselves up. Those projections are not guaranteed. Tools like AirDNA are looking at past data averages and comps, and they often assume your property is going to perform like the better properties in that set. But if the data is inflated, or if the area suddenly gets flooded with new listings, or you're just not a great operator out of the gate, your real bookings might come in way lower than the report suggested. And remember, you're taking on a DSCR loan here, which can come with different terms and higher cost than your typical owner-occupied financing. So imagine this. The lender used those rosy short-term rental numbers to approve you. The deal closes, you furnish the place, you list it, and then reality hits. Maybe you only hit half the projected nights booked. Maybe your nightly rate has to drop to stay competitive. Maybe you misjudge the seasonality and there are whole months that are basically dry. Now you're sitting on a payment that was built around the optimistic version of the story, not the actual one. That's how investors end up stuck in a loan that looks fine on the application but feels brutal in real life cash flow. So how do you use this strategy like a pro instead of like a gambler? First, you treat the lender's projections as the ceiling, not your baseline. If the AirDNA report says that you can bring in a certain amount per month, you don't underwrite your own decision off that number. You run your personal math with something much more conservative, maybe shaving down the occupancy, cutting the nightly rate, and padding your expenses for cleaning supplies, management, and repairs. If your personal spreadsheet still looks healthy under that conservative scenario, you've got a much safer play. Second, you need to know exactly what your DSCR lender will accept and not accept. Some only want standard long-term rent. Others are very comfortable with clear STR data when the property zoning, location, and setup all make sense. The more transparent you are upfront about the real plan for the property, the less likely you are to get blindsided late in the process by an underwriter or an appraiser who doesn't agree with short-term rental angle. The more transparent you are upfront about the real plan for the property, the less likely you are to get blindsided late in the process by an underwriter or an appraiser who doesn't agree with the short-term rental angle. Third, you should have a backup plan. Ask yourself, if this thing underperforms as an STR, can I shift to midterm or long-term and at least keep my head above water? Or is that a guaranteed negative cash flow? That question alone has saved a lot of people from buying properties that only work in best case Airbnb fantasy land. Now, running all this math, comparing long-term rent to potential STR income and making sure the DSCR still looks sane if you dial down the projections, doing this on napkins or random spreadsheets is exactly how mistakes slip through. That's why I built a simple guide that'll walk you through how DSCR lenders think about STR income, the questions that you need to ask about projections, and how to stress test a deal before you fall in love with it. Calculating this on your own, one property at a time, gets overwhelming. So this guide is designed to make that process repeatable. It's linked right here in the description. If you're already investing or you're actively searching for DSCR, Airbnb, or short-term rental loans, don't let one confusing line in an appraisal or one glossy AirDNA printout be the thing that makes or breaks a deal. You want to understand the story behind the numbers so that you can use this strategy to your advantage without getting trapped in a loan that only worked on paper. So here's your next step. Use the link in the description, grab the guide, book a strategy call with our team. We'll walk you through your specific numbers, what your lender options look like, and how conservative you might want to be with projections in your market. Don't let confusion around DSCR math or short-term rental income keep you stuck on the sidelines or push you into a deal that you regret. Click the link in the description to connect with the team. And if you found this breakdown helpful, feel free to subscribe. I'll catch you on the next video.